This is Trade Alive with IUX, where markets come alive and trading gets real. Let's go live.
This podcast is brought to you by IUX Trading Platform, elevating your trading experience. Welcome to Trader's Journey, a part of Trade Alive, brought to you by IUX Education, where we uncover the stories, mindsets, and lessons from the world's greatest traders. Now, picture this. It's September 16th, 1992, a day the world would remember as Black Wednesday. Across London, traders are panicking as the British pound collapses. The Bank of England is desperately spending billions to defend its currency, but nothing is working. And somewhere across the Atlantic, a calm, soft-spoken man is watching it all unfold. He sees something no one else does, a rare opportunity hiding inside chaos. Within hours, he makes a single decisive move. He bets against the British pound, and by the end of that day, he earns over $1 billion, and the world gives him a new name, the man who broke the Bank of England. That man was George Soros. But this story isn't just about money. It's about how he thought. Because for Soros, a crisis wasn't a reason to fear. It was a signal, a window, for those brave enough to see clearly when others couldn't. That's what today's episode is all about. Crisis equals opportunity. George Soros is one of the most fascinating traders in modern history. To some, he's a financial genius, a man who mastered global macro trading and built one of the most successful hedge funds of all time. To others, he's controversial, a symbol of speculation powerful enough to shake nations. But beneath all the headlines, Soros was more than a trader. He was a thinker, a philosopher who studied how human perception shapes reality. He didn't rely on charts or price patterns. His greatest edge wasn't technical, it was psychological. He understood how fear and greed distort judgment, how markets overreact, and how those emotional swings create opportunities that most people miss. His core belief was simple, yet profound. Markets aren't logical, they're reflections of human behavior. And because people make mistakes, markets do too. When everyone rushes in one direction, he looks the other way. That mindset, seeing what others can't, became the foundation of his legendary success. But to understand how George Soros developed that unique way of thinking, we have to go back, before the fame, before the billions, back to a boy growing up in the chaos of war, learning the hard way that survival and opportunity often come from seeing the world differently. George Soros was born in Budapest, Hungary in 1930, a time when Europe was tense and unstable, and the world was heading toward one of its darkest chapters. He grew up in a Jewish family, and by the time he was a teenager, the world around him had descended into chaos. In 1944, Nazi Germany occupied Hungary. The city he knew, his home, turned into a place of fear and survival. Soros and his family were forced to hide their identities to stay alive. They used false documents, moved from house to house, and lived each day with uncertainty. While most people saw only fear and destruction, young Soros was observing something deeper: how human beings behave when everything falls apart. He learned that fear spreads faster than reason, that crowds make irrational decisions, and that survival often depends on seeing reality differently than the people around you. That lesson, that perception can shape reality, would stay with him forever. It wasn't something he learned in a classroom. It was written into his life experience. When the war finally ended, Hungary came under communist rule. Freedom of thought was restricted and opportunity was almost impossible to find. Soros, still in his teens, knew he had to leave. He wanted to live somewhere ideas could thrive. At 17 years old, with almost no money, he left Hungary and made his way to London, a city that would change his life. He worked as a waiter and a porter to pay for school and eventually earned a place at the London School of Economics. It was there that he met Karl Popper, a philosopher whose ideas shaped Soros's entire worldview. Popper taught that truth is never absolute and that human understanding is always imperfect. We see the world not as it is, but as we believe it to be. Soros absorbed this idea deeply. It gave him the framework to later build his theory of reflexivity, the idea that human perception doesn't just reflect reality, it actually creates it. If people believe something strongly enough, they act on it, and those actions can make their beliefs come true, at least temporarily. This concept would later define how Soros traded and how he saw opportunity, not in certainty, but in the distortions created by belief and emotion. But before George Soros could apply those ideas to trading, he had to survive the harsh realities of the financial world. When he graduated in the early 1950s, he sent out dozens of job applications to banks in London. Almost every single one rejected him. He wasn't from the right background. He didn't have the right connections. He was an immigrant, an outsider. Finally, one small merchant bank hired him, but only for a junior role. No glamour, no big decisions, just paperwork and data. Yet, Soros made the most of it. He studied global markets at night, reading about currencies, interest rates, and trade balances. He tried to connect numbers to human behavior, to see the logic behind the movement of money. After years of persistence, he eventually moved to New York City in the late 1950s. Wall Street was booming, full of ambition and competition, but Soros wasn't interested in copying anyone. While other traders obsessed over company earnings and technical charts, he was looking at the big picture: nations, currencies, and the psychology of entire economies. Still, success didn't come easily. He faced constant setbacks, trades that failed, investors who doubted him, and the pressure of proving that his unconventional ideas actually worked. And this is where his greatest strength emerged: adaptability. Unlike many traders who refuse to admit mistakes, Soros developed the habit of questioning himself constantly. If a trade went wrong, he didn't defend his ego. He adjusted, reanalyzed, and reversed his position when necessary. He once described it like this: "It's not about being right or wrong. It's about how much you make when you're right and how little you lose when you're wrong." That mindset, the ability to stay flexible in uncertainty, became his greatest asset. Because for Soros, the market wasn't something to predict, it was something to understand and adapt to. By the early 1970s, he had finally found his rhythm. He launched his own fund, the Quantum Fund, and began applying his big picture ideas to real trades. He bet not on companies, but on currencies, governments, and global shifts. His success didn't come from avoiding crises. It came from seeing how human reactions during crises created the very opportunities others missed. When fear spread, Soros saw patterns. When the crowd panicked, he looked for balance. And when everyone thought the system would collapse, he saw where it might rebound. That perspective, born from surviving war, forged through rejection, and refined by philosophy, was what would one day allow him to turn global panic into billion-dollar profits. Because to George Soros, every crisis contained a signal, a window of opportunity hidden inside emotion. At the heart of George Soros's trading philosophy was one powerful idea: reflexivity. To Soros, markets were not machines guided by perfect logic. They were living, breathing systems, driven by human perception, emotion, and belief. Most economists believed in the efficient market hypothesis, which said prices always reflect all available information. But Soros didn't buy that. He argued that investors don't respond to facts, they respond to their interpretation of facts. And that interpretation changes everything. He called it a feedback loop, a cycle where perception shapes reality, and reality in turn shapes perception. Imagine it like this. When traders believe a stock will rise, they buy. That buying pushes the price higher, confirming their belief. But eventually, the illusion breaks. The stock falls, confidence collapses, and the same loop works in reverse. Panic feeding on panic. This is what Soros meant when he said markets are reflexive. They reflect and create reality at the same time. Where most people saw chaos, Soros saw a pattern, a rhythm of belief and correction, of human emotion repeating itself across history. He didn't try to predict the future. He tried to observe when the world was wrong about it. That single shift in thinking, from prediction to perception, became the cornerstone of his strategy. By the late 1970s, Soros had turned this theory into practice. He founded the Quantum Fund, a hedge fund that would soon become legendary for its bold global trades. Instead of focusing on company earnings or stock charts, Soros zoomed out to a macro level, studying global economies, currencies, and governments. He believed that the biggest opportunities didn't lie in the details, but in the distortions created by collective belief, when markets convinced themselves of something untrue. If investors believed a currency was strong when it wasn't, that illusion couldn't last, and when it broke, that's where the real profit waited. So Soros watched closely for moments of imbalance, places where reality and perception had drifted too far apart. He didn't chase certainty, he hunted for fragility. That approach, part philosophy, part psychology, part courage, set him apart from every other trader of his generation. And it would all come to a head in 1992, during the most iconic moment of his career, Black Wednesday. In the early 1990s, the United Kingdom was part of the European Exchange Rate Mechanism, or ERM. The idea was simple. Keep European currencies stable by fixing their exchange rates within narrow limits. But stability came at a cost. For the system to work, every country had to maintain its currency's value, even if economic conditions didn't support it. By 1992, the British pound was overvalued. The UK's economy was weak. Unemployment was high, and inflation was rising. But the government refused to devalue the pound, because doing so would look like admitting defeat. They were determined to defend the exchange rate. To them, pulling out of the ERM wasn't an option. To Soros, it was inevitable. He saw the tension building. He saw the math not adding up. And most importantly, he saw the psychology, a government trapped by pride and a market full of investors clinging to false confidence. While the world hoped the pound would hold, Soros prepared for what he believed was inevitable. He quietly began building one of the largest short positions in history, borrowing billions of pounds and selling them, betting that the currency would collapse. He wasn't gambling. He was following the logic of reflexivity. When the illusion of control met economic reality, reality would always win. As summer turned to autumn in 1992, the pressure reached breaking point. The British government was spending billions to defend the pound. The media reported daily on the currency war. Rumors spread across trading desks. Confidence began to crumble. And in Soros's New York office, the Quantum Fund team was ready. He wasn't trying to destroy the pound. He was simply recognizing what everyone else refused to see. The system was unsustainable. Then came September 16th, 1992, a day that would change financial history. The Bank of England raised interest rates first to 12%, then to 15%, desperate to keep money flowing into the pound. But traders didn't buy it. The market kept selling. The pressure became unbearable. By evening, the UK had withdrawn from the ERM. The pound plummeted, and George Soros, the man who saw it coming, walked away with over $1 billion in profit. The world called him the man who broke the Bank of England. But for Soros, it wasn't about breaking anything. It was about clarity, about understanding that in every system, truth eventually wins over illusion. He didn't just profit from the crisis. He understood it before it began. So why did George Soros succeed when so many others failed? What allowed him to see opportunity where the rest of the world saw nothing but disaster? Let's unpack it, because Soros's success wasn't built on luck. It was built on clarity, humility, and adaptability. 1. He understood perception. Most traders react to information. Soros looked deeper. He analyzed how people interpret that information. He knew markets aren't ruled by logic, they're ruled by belief. Facts matter less than how people feel about those facts. That's what reflexivity was all about. Understanding that perception doesn't follow reality, it shapes it. When everyone believed the pound was stable, he saw denial. When others ignored risk, he saw fragility. And when reality finally broke through illusion, Soros was already positioned to act. That's not luck, that's perceptual awareness. 2. He mastered emotional discipline. In trading, emotion is the enemy. Fear and greed destroy more portfolios than bad math ever could. But Soros had a different relationship with emotion. He didn't deny it, he observed it, both in the market and in himself. He was known for saying that when his back hurt, it meant something was wrong with his trades. It sounds strange, but it speaks to his awareness. He could literally feel tension building when his thinking drifted from reality. He learned to treat discomfort not as panic, but as a signal, a reminder to reassess. That level of emotional self-control allowed him to stay objective when others were blinded by fear or euphoria. 3. He was fearlessly flexible. Most traders fail because they cling to their opinions. They'd rather be right than profitable. Soros was the opposite. He could change his mind in an instant, not out of confusion, but because he valued truth over ego. He said it best himself. It's not whether you're right or wrong that matters. It's how much you make when you're right and how much you lose when you're wrong. That humility, that ability to pivot without shame, is what kept him alive in volatile markets. 4. He thrived in chaos. For most people, crisis means danger. For Soros, it meant clarity. Because crisis strips away illusions, it forces truth to the surface. While others see volatility as noise, Soros saw it as information, the market revealing its real psychology. He understood that in chaos, you don't need to predict, you just need to observe, adapt, and execute with conviction. That's what crisis equals opportunity truly means. Not optimism, not denial, but the ability to find order inside uncertainty. George Soros didn't just make money, he made an impact. After his massive success with the Quantum Fund, he devoted much of his fortune to global causes through the Open Society foundations. He invested in education, democracy, and human rights, believing that open societies, like open markets, thrive on freedom of thought. But beyond philanthropy, Soros's real legacy lives in the way traders think today. He shattered the myth of the rational market. He proved that psychology drives price, and that understanding people is just as important as understanding economics. He showed that a trader's greatest tool isn't a chart or indicator, it's the mind. The ability to stay rational when the world is emotional, to act when others hesitate, and to see truth through the fog of panic. So, what can we, the next generation of traders, investors, or even decision makers, learn from Soros? Let's distill it into a few timeless lessons. 1. See perception, not just facts. Facts don't move markets, beliefs do. Learn to read the crowd, and you'll see opportunity before it's visible. 2. Detach from ego. Being wrong isn't failure, staying wrong is. Admit fast, adjust faster. 3. Find calm in chaos. Crisis doesn't destroy opportunity, it reveals it. Your ability to stay objective when others panic is your greatest edge. 4. Think globally, act decisively. Don't limit your view to one asset, one idea, or one strategy. Look at the world as a connected system. When one part breaks, another part opens up. 5. Turn awareness into action. All the insight in the world means nothing if you don't act on it. Clarity without courage is wasted potential. For George Soros, wealth wasn't the goal. Understanding reality was. He saw markets as mirrors of human nature, messy, emotional, yet full of rhythm and opportunity. His success came not from knowing the future, but from seeing the present more clearly than anyone else. And maybe that's the ultimate takeaway for all of us. You don't need certainty to succeed. You need clarity, adaptability, and the courage to act. That's how crisis becomes opportunity. George Soros' story reminds us that no matter how unpredictable the world may seem, there's always a pattern, a moment where chaos turns into clarity for those willing to look deeper. The question is, when the next crisis comes, will you freeze or will you see? If today's story inspired you, share your thoughts with us. What do you think about Soros' philosophy? Is crisis equals opportunity something you've seen play out in your own life or trading journey? Leave a comment, follow, and subscribe to Trader's Journey, a part of Trade Alive, brought to you by IUX Education. And if you want to go beyond listening to learn trading principles, build strategies, and practice risk-free, visit IUX Education, where you'll find free learning materials, educational content, and a demo account to sharpen your skills. Until next time, stay curious, stay disciplined, and keep learning.
You've been listening to Trade Alive with IUX. Ready to put these insights into action? IUX is here to power your next winning trade.